See, the key thing that resonated there is you went and you obtained the advice, right? You did an engineer.
Absolutely.
That's a critical part in this journey.
And out of the setup cost, the biggest cost comes to that financial advice piece. And I'm not shy of paying that, because if I am putting my retirement savings into it, I do not mind paying fees to make sure I start at the right step. The first step has to be right.
It's the most important.
You get it wrong and your retirement saving can be wiped out. Why try to design it by reading things online yourself and listening to friends? Get the professional advice and then start your journey. Hello everyone, and welcome to another episode of Building Generational Wealth through Strategic Property Investment. I'm your co-host Sandeep Jagtap, Director at Finso's Mortgage and Finance Brokers, and along with me I've got our co-host George Churchian, Director at James Chase Buyers Advocacy. So welcome George to another episode of our podcast.
Good to see you again, Sandeep.
Yeah, and excited to talk about everything self-managed super fund in terms of how it fits into your strategic property investment. So before we start, we are not here providing any financial advice, any accounting advice. It's general discussion about how that special vehicle of self-managed super fund can be used to invest and take ownership of your own retirement. So that's what we are talking. It's general advice only. It's no financial advice, and we're not going to provide that in any way.
I'm very much looking forward to unpacking this with you. I know, talking prior to kicking off this recording session, both of us have had people from our respective sort of circles approach us and ask about self-managed super funds. So I think it's quite timely. It
is. People have been asking us to bring this to the table and dive deep more into it. We have done seminars on that in the past with the accountants and buyers, agents, solicitors, everyone. But it's just the topic that just has got so much interest in there and so much to be done in the self-managed super funds. And that's why we bring this episode. So I'm excited about it, George, to talk about self-managed super funds and investing through it.
Let's get started.
Okay. So before we start, George, where does self-managed super fund stack and what is actually a self-managed super fund? A typical PAYG or self-employed person would have their super going 12.5% super at every pay cycle going into the industry or retail super funds.
Yes.
We grow that super to a certain point before we can think of a self-managed super fund. Does everyone have to do a self-managed super fund? I don't think it's for everyone.
I don't think so either.
But it's for those sophisticated investors who have bought a few properties in their portfolio before they can think of a self-managed super fund. That's my view, because I would not recommend any fresh investor to get into this, because there's so much compliance, there's so much things those need to be done. There are costs associated with a self-managed super fund, and you need to be hands-on, really speaking, when you buy a property under self-managed super fund or you want to set up one.
You do, very much so. And going back to the point earlier around obtaining that independent advice, because there's a level of diversification that financial advisors would want you to maintain. So with that in mind, it very much is something that one should approach with a level of caution and the right advice.
Great. So before we get started, just a little bit of data. I love data, and that's where, I have got some interesting information about how much is owned in self-managed super funds. Like less than 600,000. Like it's so much to be done in super. There's not too many people have self-managed super funds. So how does it stack up at the moment? There are about 661,000 self-managed super funds serving just over 1.2 million members. So given Australia's population, and if most of the working people would have some sort of super, 661 self-managed super funds is not a big number. There's so much to be done in that space. There's so much opportunity in that space.
It's the minority, isn't it? It's a small number.
Yeah. And as we see, like not a majority of Australians don't own more than two investment properties. So that just tells you that how much is there to be done. A market share of the self-managed super fund is roughly a quarter of Australia's 4.4 trillion super fund. So really, a trillion there. And the recent figures are really exciting. So recent growth is accelerated sharply with the last September quarter of 2025 seeing a record of 14,000 new registrations. So if we say in 25 years of self-managed super funds, we have 600,000, just over 650, 661,000 super funds, close to 14,500 super funds. That is a massive growth.
It's certainly a very big uptick.
Yeah, and where does that come from? As the lending become difficult, people found it difficult to add to their portfolio, and they were sort of thinking, is a self-managed super fund a vehicle they should really explore? Because as the 12, 13 interest rate rises went through, lending become difficult.
Absolutely. And I also believe that people are actually taking a more direct involvement and a direct control over their wealth creation journey, right? So, of course, again, taking direction from their advisors. But the fact that there's a uptick of over 14,000 in that short span of time, it really is indicative to say people are taking more of a vested interest in their future.
Yeah. And where does the asset allocation primarily sits at the moment? So SMSF trustees favor direct control over their investments compared to the registered super funds, the industry or retail super funds. So Australian listed share is the dominant asset class at 27.6%, which is close to 296 billion.
Mm-hmm.
Cash and term deposits, 15.7%, which is significantly defensive and a safe investment. That's about 169 billion. Real property, combined property accounts is 16.1% of the assets, with commercial 10.5%. Significantly, commercial is something that's residential and commercial as a real estate. It forms significant part of that sort of pie in the total investments. However, emerging assets like cryptocurrencies, you would be surprised with the figure that they have reached in the short period of time.
I'm almost worried, Sandeep.
Mate, it's not that worrying, but it's still significant. Like they reached 3.2 billion or 6.3% of the sector.
Okay.
While the exchange traded funds have surged to 12%. Exchange traded funds still would be safe compared to the crypto. Like crypto, for those who are hands-on and do a lot in that space, they can generate a lot of growth out of it. But if you ask a person like me who understands crypto a bit, but I'd probably steer a little bit clear. I don't mind Australian listed shares or exchange traded funds if I was to think of those sort of assets to invest in, right?
Possibly slightly less volatile, I imagine, than cryptocurrency.
Yeah. So look, that's some numbers about how self-managed super funds track. Geographically, how self-managed super funds are in Australia. New South Wales, it's not a surprise, leads 33% of all funds, followed by Victoria at 30.5% and Queensland at 17.4%. So the eastern states really go to 3/4 of all the super funds in Australia.
Yeah, it's indicative, and they embrace it. And certainly when I'm engaging with clients and prospective clients, like we were saying in our previous episode, I've seen a very big uptick in self-managed super fund clients and buyers. So at the moment, in terms of our active client books, more than a third of them who are investors are investing through their self-managed super fund.
Yeah, and not surprisingly so, given the COVID time when the cash rate was absolutely close to the zero mark.
Yes.
And from there, we have gone up 4.5%.
Yes.
So the home loan interest rates at 2%, or even under 2%, like fixed rates, I've seen fixed rate of 1.89s and 1.79s at a certain time. And at the moment, we are looking at the home lending rates in the mid 5s to 6s.
So triple almost.
Yeah. And that's where I think people found it difficult to borrow. And that's where a lot of experienced investors look at these sort of vehicles to sort of use to add to their portfolio.
It's certainly a good option. And again, if you've got the right advice, you're comfortable, you understand the pros, the cons, the risks and the opportunities, it does make sense. The other element as well, as you mentioned, is if you entered at a time where borrowing costs were significantly low, and then over the course of 24, 36 months, they've tripled, it's being able to sort of sustain your investment as well and not necessarily being forced to exit it.
Yes. And a key point you mentioned, George, in your comment is as long as you get the right advice. When one sets up a self-managed super fund, if someone asks me what is the key piece of this journey or puzzle, I think the right financial advice and accounting advice is absolutely necessary. You need a smart approach to that. Reach out to your accountants, financial planners, and see if this is for you or not to start with. Are you ready for it yet? It may be for you, but not ready yet. To give you an example, I get clients who come to me when they have $150,000 in super.
Sure.
Combined with the husband and the wife. And they still want to set up a SMSF. And our position is definitely talk to your accountants and financial planners. However, that's not the point when you should set up a self-managed super fund. Ideally, over $200,000, APRA says $250K to really get the benefits of it. Because self-managed super fund, mind you, has got a lot of management costs. Or the setup cost and management costs.
I was going to say exactly that. The setup cost is quite comprehensive. It's significant, and it's an extensive process. It's not something you would do overnight, even once you've got the advice. And then the cost of running it too. So I'm sure as we sort of continue, that there's a level of compliance associated with self-managed super funds. So it's heavily regulated, and going in at the right mark with the right cash flow, right budget, makes sure that you're set up to succeed.
Yeah. And so how does a self-managed super fund typically work? What is allowed, what is not allowed? To just give you or our audience a brief idea of what it is. A self-managed super fund can have between 1 and 6 members, so up to 6 members. Mm-hmm. You have better control than the retail super funds or the governed APRA governed super funds investing your money, depending on your financial advice that you have received from your financial planner and the accountants. You can invest in certain assets like direct property, shares, cryptocurrency, managed funds, and whatnot. However, with that control comes great deal of responsibility. The trustees are personally liable for all fund decisions, and they have to ensure that annual independent audit is conducted annually, and the annual return is lodged with the ATO. And during those audits and these filings, if the fund is found that it's non-compliant, the things are not being done as per governed by the regulatory bodies, you may seize the capacity to run a self-managed super fund and have to go back to the self-managed outside the listed supers and all.
Yes.
But the beauty of self-managed super fund is the leveraging benefit that one gets and the taxation. So the compliant super funds generally pay 15% concessional tax rate, give or take, and which it can drop to 0% once in the retirement phase. So that's where I think, it's very important. It's a great vehicle. If you understand it well, if you seek the right advice, it's a great vehicle to generate significant wealth for your retirement, taking control of your retirement funds.
Very much so. If you play by the rules, it's designed to treat you well when you reach a maturity age. So my understanding is it needs to satisfy the sole purpose test, which basically means that the whole intent of the self-managed super fund is for the benefit of the beneficiaries at retirement. So if you treat it right, play by the rules, and come retirement, then those tax benefits certainly kick in.
Yeah. So the benefits, pros and cons of self-managed super fund as such, you get more flexibility on investing, the asset classes and what you can do. It's cost effective really if it's really done well. If it's done over 200 or 250, then it becomes cost effective, and the incentive is there to build a self-managed super fund. If somebody has got 100, 120, 150K, then the costs outweigh the benefits really. And the third benefit, which is not talked often, is estate planning, greater control over the benefits and how they are distributed to the beneficiaries, right? However, the cons of that would probably the compliance risk. There are significant penalties for non-compliance and can be severe, right? Including your tax concessions. No compensation, unlike other funds where generally you cannot access the government compensation if there are losses due to fraud and all. So you need to be switched on and can't get carried away into vehicles that are high risk.
No.
One should not.
Certainly. And you're not supposed to game the system either, right? So there are rules and compliance in place for your benefit, then adhering to those. And certainly there are rigorous checks along the way as part of your annual audit process. And being, having gone through that myself, I can share, and I know you as well, it's quite an extensive process. So there are questions asked and you need answers.
And there's no shortcuts.
No.
There's no shortcuts, and you can't turn the clock back and correct something that was done wrong.
No.
So I think those annual audits are really good checkpoints.
Yes.
To see how you're traveling and keeping your super in control. And the biggest thing is it requires significant time, record keeping, reporting, and keeping updated on any changes and the regulations that happen. So that's, I think, the pros and cons for self-managed super fund.
That's right. And to your point earlier, there's a right entry point, I believe, in terms of the balance of your superannuation in the retail space. So the investors we see that do really, really well is those who go in with healthier budgets. So to the example you used before, so going in at 150K, will it put you in a position where you need to all of a sudden make additional super contribution payments, extra concessional payments? That's not the ideal scenario.
And, getting into a property investment at that 150K is not really a viable option, because if you look at the properties anywhere in Australia, generally decent properties, you are looking at something around that 700,000 price range. If that's
Certainly.
the case, putting it 25% for deposit and buying costs, that's your 175K gone. So minimum 175K is probably someone need to buy an asset worth $700,000.
That's right. And, to your point, the asset selection becomes even more critical in the self-managed super fund space, because ultimately you need to be hands-off, right? So, and as we continue to talk about what you can and can't do, we'll unpack, there's a lot that you can't do that you can outside of the SMSF arena. So it's a critical part of the whole SMSF journey.
Well said, George. And that's where, setting up a self-managed super fund and having all the funds going towards a property investment can become risky. So as a part of the financial strategy, when you sit down with your financial planner and do that, is
Yes.
that the statement of advice from the financial planner would contain X amount in the property, then something in the self-managed super fund, something in term deposits, and shares, listed shares as such. So that's a real diverse sort of distribution of your funds, so that you do not risk everything in one sort of basket.
Risk management's important in that space, certainly.
That's where I think one needs to be really sure and have that detailed discussion and seek that statement of advice. A lot of people ask me, is it necessary to get a statement of advice and get a financial advice? And I say, why would you jump into something without knowing what lies there for you? What are your responsibilities? How can you really grow? To give you a good example, Nilima and myself, we set up a self-managed super fund a few years ago, and we bought a property in that. When we bought the property, we were 50 years old. So why I thought self-managed super fund was right for me is both of us want to work till the age of 67.
Okay.
And that gives us about 17 years. If we buy asset
Yes.
and hold it, that gives us enough time for that asset to grow in value, to provide for our super and pay down the mortgage on that, so that we are left with good money to draw the pensions from and have a plan for our better retirement.
It's a good approach because hearing you talk through that, you're basically leaning into the fundamentals of property investing, right? So you're giving yourself a long time horizon. So with 17 years, you'll get at least 2 property cycles.
Absolutely.
Maybe even a little bit more. But then also over a timeline like that, you'll benefit from the compounding benefits of property investing, which is the 7th or 8th wonder of the world.
Yeah, and look, other thing is, George, giving more time protects you from the market fluctuations like the GFCs.
Yes.
These things will come and go, and the markets being solid in Australia
It has
will
been.
keep performing. And that's why you need more time. I don't want to time the market. I want as much time in the market when it comes to an asset class like self-managed super fund, investing to self-managed super fund. So we went to our accountant and our financial planner, sat down with both of them and asked them, are we ready yet? At that time, we had about $170,000 in our super. So we were not ready. So what we checked was, is there an opportunity to speed it up, or should we wait for the 12.5% contributions to take it to 250, which would have cost us another 2 to 3 years in opportunity?
Yes.
We had the cash flow, we had the cash savings or accumulated over the years. So checked with Mr. Accountant how many years in the past we can go.
Sure.
And use those caps where we can contribute up to $30,000 each to the super at a concessional tax rate.
Understand.
And one can contribute that for the current year, but previous years as well. And your accountant should be able to check how much you can contribute.
Yes.
So and that time our salaries were in that higher tax bracket. So putting that concessionally into super help us save some tax in the short term, and also bumped our super over that 200K mark, where we could be able to buy that property as such and set a self-managed super fund, buy a property, and sort of look at that 17-year period. So yes, we were not ready, but we did not jump the gun and set up a self-managed super fund under that threshold of 250K. We worked with our accountants and financial planners, got the statement of advice, and contributed those additional payments and bumped up our super, and we're ready for the property. So we not only saved time to get into the market, but we also saved some tax while we did that, and we're ready. In the statement of advice, a typical statement of advice, it's a big document and takes a long time to understand it. So what we did was we sat down with our financial planner who explained that document to us. It's a tedious thing to understand. So many technical terms, so many numbers, so many projections.
Yes, sir.
So with our financial planner, we sat down and we said, okay, this much goes in our property. We put this much in the managed funds. They recommended some certain funds. We also did our research, some listed shares, long-term blue chip good shares. So those are the things which will generate that cash flow to pay down your mortgage faster.
There you go.
So in 17, 18 years, you should be in a good position to have that asset free to generate income from that. And when I get to that retirement age, and if the same current laws apply, the gains, the tax would be zero at that stage, right? And that gives me access to funds for retirement without being worried about the tax side of it.
See, the key thing that resonated there is you went and you obtained the advice, right? You did an engineer.
Absolutely.
So that's a critical part in this journey.
And out of the setup cost, the biggest cost comes to that financial advice piece. And I'm not shy of paying that, because if I am putting my retirement savings into it, I do not mind paying fees to make sure I start at the right step. The first step has to be right.
Part. It's the most important part.
You get it wrong and your retirement saving can be wiped out.
Yeah.
Why try to design it by reading things online yourself and listening to friends? Good to pay the professionals, get the professional advice, and then start your journey.
Certainly, especially if you don't have a long time horizon in your journey, then that becomes all the more critical.
Yeah. And so how does the process typically work, George, for our audience? So say, for example, a couple comes to us and say, hey, we want to explore this opportunity. We already had a chat with our accountant and our financial planners. We have got in excess of 250K in our super collectively. We have got the financial advice. The accountants, solicitors, the financial planners have helped us set up the self-managed super fund. So a self-managed super fund is a trust, which can have an individual trustee or corporate trustee, of which the beneficiaries are the directors as well, right? So in that space, I generally, the most preferred one is the corporate trustee structure. So self-managed super fund, the trustee company, and so Nilima and me are the directors of the trustee company. Sure. So the self-managed super fund is set up. Then we opened the bank account for the self-managed super fund. Once the bank account was opened, we filled up the rollover forms.
Yes.
with our existing industry super funds to roll over the funds from the industry super fund or retail super fund into our self-managed super fund.
Yes.
So we have control of it for the investment purposes. Once that's rolled over, then we are ready to buy a property. And this can take significant amount of time. Like statement of advice, setting up of super fund can anywhere take between 1 and 3 months.
It can,
or more.
It can take a lot of time. And ironically, the managed funds or the retail funds don't like letting go of their money. So my observation from working with clients is rolling over those funds takes a lot longer than what people usually anticipate. So
yes. And that's where I think things can get delayed. Once the account's open, the funds are rolled over, they sit down with us to see what their borrowing capacities are, and then probably come to you to see what is the property, given the time they have, given the funds they have, given the borrowing capacities they have, and then jump into the property. I've seen people going search of the property, sign a contract to buy a property, and they had not set up the self-managed super fund. How dangerous can that be?
It is. It's a lack of planning, and ultimately you're not going to get much done, frankly, because you can go shopping, but if you're not geared up to, secure anything, then it's just not a good use of your time, really.
Yeah. So that's the process as such. So a self-managed super fund is one entity. There's another entity which comes into play when the property is finalized, which is called the bare trust or the property holding trust. That bare trust will buy the property or own the property, and the self-managed super fund will borrow the funds.
Yes.
Right?
Correct.
And again, one super fund can have multiple property holding trust, and people can buy multiple properties as they can go in there, right?
Yes.
So that's just a high-level view of how the super fund looks like. Now, key thing which people forget, and they should not, is the insurances. We are not getting any younger. There is a risk, and assets are being purchased, and there is financial liability against it. So one needs to be thinking of their insurances very seriously. So a lot of people have big insurances with their existing super funds. So when they roll over the funds, one may not roll over the entire super into the self-managed super fund and keep a certain amount in the super fund to keep the insurances alive. If you cannot get super fund insurances outside the super, given the age, like I got an insurance when I was 35 years old in the super, and I kept it, upgrading it every 2-3 years with the value. Mm-hmm. However, at the age of 50 with certain ailments, you cannot get the insurance, or you get it way too expensive. So good to keep the existing insurance alive.
Very much so. You need to have that cover. So should the worst happen, then again, you don't need to go and sell down your asset.
The survivor is not at risk, right?
Yes, that's exactly right.
Yeah, so that's just an overview of super, George. And there's so many regulations of what type of property you can buy in a super. So as a property expert, if I was your client coming to you to buy a property in self-managed super fund, I've got 17 years to go. We've got about 200 plus in super, 700K, 600K sort of borrowing capacity. What sort of advice would a strategist like you provide on that?
So typically, again, we're very much bound by what you can and can't do in the self-managed super fund arena. So first of all, I guess it's around sort of educating the customer to say what these things are, what these limitations are. For example, if you are a seasoned investor outside of the self-managed super fund arena, you typically would draw down on your equity, use that equity as a deposit to buy another property, or use the equity to make maybe some cosmetic renovations, upgrade the kitchen, bathroom, etc. In the self-managed super fund space, as you know, we cannot do that. We cannot.
One property, one loan. So that is a key thing our audience need to understand is, if I bought a property in my personal capacity, the property grew by $300,000, I can go to the bank, borrow $200,000 more to do some structural renovations. I can't do that in the self-managed super fund. One property, one loan. If I start a loan at $700,000, it can only reduce, it can't increase.
Exactly right. So we can't tap into the equity. So for us, the approach is not about manufacturing equity. So one thing that we will notice, though, as time goes on, especially if there are more than one members in the fund, so if it's a husband and wife, for example, you'll have your contributions coming in, you'll have the rental income coming in, and after a certain time period passes by, your funds and your offset will start to snowball. And I guess that's when we start thinking eventually about another purchase or another form of investment outside of real estate. So typically speaking, we want to buy assets or residential assets that are fairly low maintenance. So
Or set and forget, in other words.
Set and forget, in other words. So typically, we are pulling together a scope for a client. We're buying things that are low set. We're buying things that are brick. We're buying things that don't have a pool, simple yard maintenance, very much set and forget. Personally as well, we tend to sort of avoid weatherboard type properties. We go for brick just for longevity, especially if there's a longer time horizon for the client. And ultimately what we want to see in a perfect world scenario, again, is rental income coming in, loan expenses going out, and then of course you will have the odd repair and maintenance associated with the property as well.
So the geography is also key, where you buy it so that it is rented most of the time of the year, so that your super contributions and the rent can pay that mortgage, and you do not have to contribute additional into the super to sort of keep it running. That's the reason.
Exactly right. So geography certainly comes into play, and we don't want to be making, like you were saying earlier, additional contributions just for the sake of paying down a loan, right? If that's not part of the strategy. So if we squeeze too hard and try and enter the SMSF market prematurely, ultimately there's going to be a bit of financial pain resulting in you making additional payments into your super so you can make ends meet. So that's not an ideal scenario. So typically we want to go in at a high threshold. We want to buy an asset that is sustainable, that is low cost in terms of maintenance and holding, but then also allow us to essentially set and forget that in the SMSF space. So typically speaking, and again, when we look at budget and entry point, so a $700,000 budget in the self-managed super fund is very much on the modest side of things, right? So you're going to buy an asset that is very much considered entry level. What we are seeing in our business for clients who are coming in with a self-managed super fund, they're coming in at a level that allows them to purchase $1 million asset or thereabouts. So you are buying something in a fairly sort of metropolitan area. Again, we touched on Moreton Bay and things like that in an earlier episode. So we're buying in areas like this. We're buying in the Central Coast. We're buying in regional parts of Victoria. And it's getting us good assets, low maintenance, good locations, and all the fundamentals that we would look for as investors in general. We want to buy in areas where families are attracted to, where there's investment from local, state, federal governments that tell us that these areas will grow. So all of those boxes are still ticked, but we're a lot more careful when it comes to the asset selection for these reasons.
Great. And that's a good point you made, George. It has to be an asset which will not chew more into your super while it grows, right? And in terms of lending, there are a few do's and don'ts, or can or can't do's there. So first thing first is, in a self-managed super fund, the borrowing comes at a very high cost.
Yes.
We are looking at interest rate upwards of high sixes to low to even mid sevens.
Yes.
Because most of the standard or the big lenders or the deposit taking lenders do not work in that space. And that's why you have got these non-bank lenders and funders who work in that space. And that's where there's that high risk and the cost of borrowing funds for them plus their margins. And that's where I think the interest rates are a bit high. That's one needs to keep in mind. They can't expect a 5% interest rate on a self-managed super fund. When I said non-bank lenders and all are working in that space, surprisingly enough, recently AMP Bank came up with a self-managed super fund offering again.
Okay.
The big banks used to be in that space. They, one by one, everybody pulled out. AMP pulled out too, but AMP have come back as of February into self-managed super fund lending space.
That's an interesting U-turn.
It is. However, it's still a start. If I am not wrong, the summary I've read, it's 300K plus in the super, plus 5% buffers. And also they have put their buffers in place. So it's not, every super fund is not their customer.
That's right. They're not chasing everybody.
Yes, they're not chasing everyone. They know their market. They want to play in that market. So borrowing capacities are limited. Personally, I can borrow more. But in a self-managed super fund, it's hard to borrow as much as I could borrow in my personal capacity. That's where the purchase prices and the property price brackets come a bit lower. In a self-managed super fund, I cannot draw equity. The only way I would draw equity is probably sell that property, pay the CGT if I'm not in that retirement age at that stage, and then contribute and see if I can buy 2 properties. Building a granny flat at the back. No bank is going to lend you to build a granny flat on the property under a super.
That's right.
Right? So one would have to come up with that. But rather than coming up with 200,000 plus to build a granny, I'd put $200,000 deposit in another property and go for another one.
Exactly right. That's right.
So those are the things one needs to be considered when it comes to lending. And and also the audit requirements and the lodging of all the required regulatory documents every year is absolutely key when it comes to lending. So you can't look. A lot of banks steer away from those of the plans and home and land packages in that space. They generally like the idea of established and sound properties in that space. Would you see that too?
Very much so. So there's a lot of off-the-plan, operators who are targeting the self-managed super fund industry, for lack of a better term.
Not that they don't lend, but they steer away.
Well, yeah, that's right. There's the approach that they take is quite conservative and low risk, so it makes sense.
Yeah. So that's just a summary of it, George. We can go for 1.5 hours if we start talking to self-managed super fund. But that's just a bit of a summary of how self-managed super fund can be a great vehicle. So if I had 250,000 sitting in my industry super fund, it grows 7 to 10% a year. I would get that growth of 7 to 10% on that 250K. But now, since I put 200K into the property and borrowed 700, I bought a $900,000 property in New South Wales, which New South Wales grew by 5.5% last year, as we said in our last episode.
Yes.
So I'm getting a 5.6% growth on realistically a $900,000 asset. Yes, I do have a mortgage on it. I pay interest on it.
Yes.
However, the growth over a number of years will be significant.
Absolutely, it will. It's a very attractive proposition.
Yeah. Do you have a super, or would you consider investing through self-managed super fund, if I may ask?
Yeah, good question. So we also entered that space a number of years ago. So going back from memory 3-4 years ago.
Similar time that we got in.
Similar time, exactly. And similar approach. You want to make sure that you get the right advice, that it works for you, it's right for us. And then we went through, set it up, we rolled over our funds, and we made a purchase in regional Queensland at that time. And the property has essentially sort of doubled in that short time frame, right? So there will be a point in time where we sort of look at that and go, do we add to it and secure another property, or do we sell down and move on to something else?
Yeah. Good thought, George. And that's very important. So one needs to understand, is super fund right for me? Is the first question they need to ask. Ask the accountant, financial planners, is it right for me? Do you guys see me being ready for it?
Yes.
If not, how to get ready by making additional contributions into the super if your cash flow and your savings allow that.
Yes.
If not, then wait till it builds up to there.
Yes.
Do not be creative in property buying or self-managed super fund is what I always think is one cannot be creative. It should be as set and forget as possible.
In this space, boring, repetitive, and fundamentals is the path to success. In my view.
George, you hit the nail there. Boring is the right word in self-managed super. You can't make it too exciting.
No, not at all.
Set and forget. One needs to have real good time horizon.
Yes.
To make that work. If I am 65 years old, may not be for me at that stage.
No.
Setting it up early so that I get 1, 2, 3 property cycles to get that growth in the property.
Long-term view is always best.
Even the shares I invested after we bought the property, the shares and exchange traded funds we invested today, by the time we get to that retirement age, they will be significantly grown as well. So giving shares, you can see the news updates every night. The market went up this much that day and went down that much that day. However, if you look at a longer term horizon, you get a real good, decent growth as long as you invested in the right asset classes.
Certainly. And you're able to sort of tolerate the ups and downs of whether it's the stock market or the real estate market as well. So having a long-term view and a level of, tolerance to risk and to those fluctuations will set you up to succeed over the long term.
Yeah, in the short term, you will see those whipsaw behaviors patterns. But in the long term, you see that steady growth. And that's where I think time in the market in super fund, being boring, making sure you get the right advice. In terms of borrowing as well, with these lenders, the entry costs are high.
Yes.
You need to pay for the legal advice, for independent legal advice when you sign the loan documents. The application fees are high, the valuation fees, everything is charged. And refinancing in self-managed super fund is difficult too, because refinancing costs are high.
Significant.
Because going to a new lender is going to cost us more money for setting up the loan. However, discharge fees, the lender I am with charges me 3 months of interest as discharge fee on top of discharge fee. So that is penalties for early repayment in self-managed super fund. So that's where our responsibility when selecting a right lender for our clients into a self-managed super fund is really important to make sure that they are not worse off, because it's really hard to change it.
Certainly. There is very much an impact, and a material one, when you're transacting at that regular rate. So that long-term slow approach is very much, I think, the approach people should take. Just sort of sitting here reflecting, I think boring super, that's probably a name that we can copyright and talk to some of our lending BDMs about.
Yeah, absolutely. Look, and I think, George, we will keep coming back to things in super fund, self-managed super fund. As we discuss few other topics, we will always talk about how it fits into the self-managed super fund space as well, because super fund is a really difficult topic to be covered in 25-30 minutes.
Certainly is.
So we will definitely come back to it, but just wanted to summarize for our audience, what is a self-managed super fund? Can that be used? Yes, it's a great vehicle. It's regulated, so it's not a risky sort of space to be in. And strategists like you can find properties that fit that particular guide or scope. And that's where I think one can really, if set up correctly with the right professionals on by your side, right people like us who will provide advice on borrowing under that, and right people like yourself who can secure a right asset.
Yes, to the asset selection, certainly.
And one also needs to understand they need to catch up with their financial planners on a regular basis to see, are there stocks investment, are there ETFs investments, everything is going as per their plan, because that financial strategy is set up after the statement of advice at the beginning when the super fund is set up. But one should not set and forget that. One needs to keep revisiting, and as the market change, as the laws change, as the regulations change, one needs to sort of, and your age changes, which is inevitable. One needs to make sure that they are still on track to achieve at 67. I'm on track to achieve what I wanted to achieve at 67. The roadmap that my financial planner gave me on the first day is not going to be the roadmap. I need to change course as and when things change.
Certainly. And I think when we said earlier, sort of set and forget approach, it's very much obviously tongue in cheek. So there are, things you need to monitor: your expenses, your income, your holding costs, your strategy, your plan, your circumstances. So that sort of review, it goes hand in hand with any sort of investment, certainly.
Great. George, good session, good podcast today. I think this is what the audience wanted to hear about. So hopefully you get something out of it. And more than happy to sit down with you, with your accountant, financial planners in a strategy to see whether super fund is right for you and how we can help you achieve what you can or aim to achieve for your retirement sort of savings. So thanks, George. Thanks once again for joining this one. And we'll come back again in the next episode on a different topic.
Looking forward to it, Sandeep. Thank you so much.
Thanks, George. And thank you, everyone.